Forex trading is the act of buying and selling different currencies. It is short for foreign exchange. Think of it like exchanging your home currency for another when you travel abroad. The Forex market is where these exchanges happen on a massive scale. It is the largest financial market in the world. Trillions of dollars are traded every single day. Unlike a stock market, the Forex market does not have a central location. Instead, it operates 24 hours a day, 5 days a week, across a global network of banks, corporations, and individual traders. This constant activity provides many opportunities for people to participate. The goal for a Forex trader is to profit from the changing values of currencies. For example, if you believe the euro will become stronger against the US dollar, you would buy euros. If your prediction is correct and the euro's value rises, you can then sell the euros for a profit. This is the basic idea behind Forex trading. Traders analyze different factors, such as economic news and political events, to guess which way currency prices will move. The constant fluctuation in currency values is what creates the potential for making money in this exciting global marketplace. Many beginners are attracted to Forex trading because of the promise of quick and large profits. However, the real secret to success is not about making one huge winning trade. It is about achieving consistent profits over a long period. Consistency means earning small, steady gains that add up over time. This approach is much safer and more sustainable than chasing large, risky trades. Big wins often come with the risk of big losses. By focusing on consistency, you build a solid foundation for your trading career and protect your trading capital from being wiped out by a single bad decision. The journey to becoming a consistently profitable trader begins with education. You must first understand the fundamentals of how the market works. This includes learning about currency pairs like EUR-USD or GBP-JPY and understanding terms like pips, which are the small price movements. It also means recognizing that Forex trading involves risk. There is no guaranteed way to make money, but with the right knowledge and a solid strategy, you can significantly improve your chances of success and turn Forex trading into a reliable source of income over time. One of the simplest and most effective strategies for beginners is trading with support and resistance levels. This strategy does not require complex indicators or expensive software. It is based on observing how prices behave on a trading chart. Support is a price level where a falling price tends to stop and reverse, going back up. Think of it as a floor that holds the price up. This happens because there are many buyers waiting at that price level, creating strong demand that prevents the price from falling further. Identifying these floors is a core part of this reliable trading method. On the other hand, resistance is a price level where a rising price tends to stop and turn back down. You can imagine it as a ceiling that the price has trouble breaking through. At a resistance level, there are many sellers who want to sell the currency, creating an oversupply that pushes the price lower. These levels are important because they show us where the market's momentum is likely to shift. By finding these key price ceilings, traders can make informed decisions about when to sell a currency pair, anticipating that the price will likely fall from that point. The beauty of the support and resistance strategy lies in its simplicity and logic. It is based on the basic principles of supply and demand that drive all financial markets. When the price reaches a strong support level, demand is high, and it is a good time to consider buying. When the price hits a strong resistance level, supply is high, and it might be a good time to sell. This approach provides clear entry and exit points for your trades. It helps you avoid guessing and instead allows you to make decisions based on historical price behavior, which often repeats itself. This strategy is particularly good for achieving consistent profits because it inherently helps manage risk. By placing trades near these strong support or resistance levels, you can set your stop-loss orders very close to your entry point. A stop-loss is an order that automatically closes your trade if the price moves against you by a certain amount. This means if you are wrong about the direction of the trade, your potential loss is small and controlled. This focus on minimizing losses is crucial for long-term survival and profitability in the competitive Forex market. The first step is to identify the support and resistance levels on a currency pair's chart. You should look at a longer-term chart, such as the 4-hour or daily chart, to find the most significant levels. Look for price points where the market has reversed direction multiple times in the past. Draw a horizontal line at these price points. For support, find the lowest points where the price bounced up. For resistance, find the highest points where the price turned down. The more times the price has touched a level and reversed, the stronger that level is considered to be. Once you have your support and resistance lines drawn, the next step is to wait for the price to approach one of these key levels. For example, let's say you are watching the EUR-USD pair and you have identified a strong support level at 1.0800. You need to be patient and wait for the price to fall and test this 1.0800 level. Do not jump into a trade when the price is in the middle of the range between support and resistance. The highest probability trades occur right at these important boundaries where market decisions are made. When the price touches your identified level, you need to look for confirmation before entering a trade. Confirmation is a sign that the level is holding and the price is about to reverse. A common confirmation signal is a specific candlestick pattern, such as a hammer at a support level or a shooting star at a resistance level. For instance, if the price hits the 1.0800 support and a bullish hammer candle forms, it's a strong signal that buyers are stepping in. This confirmation tells you that it is now a good time to enter a buy trade. After entering the trade, you must immediately set your stop loss and take profit orders. For a buy trade at the 1.0800 support level, you could place your stop loss just below that level, perhaps at 1.0780. This limits your potential loss if the support breaks. Your take profit target would be the next resistance level you identified, for example, at 1.0900. By setting these orders, you have a clear plan for both your maximum risk and your potential reward. This disciplined approach ensures you are managing your money wisely on every single trade you take. Patience is perhaps the most important virtue a Forex trader can have. The market does not offer perfect trading opportunities every minute of the day. Using the support and resistance strategy, you might have to wait for hours or even days for the price to reach your pre-identified levels. This waiting period is where many beginners make mistakes. They get impatient and force a trade when there is no clear signal, a behavior known as overtrading. A successful trader, however, has the patience of a sniper, waiting calmly for the perfect setup to appear before taking a shot. Discipline is the partner of patience. It is the ability to stick to your trading plan and rules no matter what. This means always using a stop loss, never risking more than a small percentage of your capital on a single trade, and not letting your emotions control your decisions. For example, after a losing trade, you might feel tempted to immediately jump back into the market to win your money back. This is called revenge trading, and it almost always leads to bigger losses. Discipline means accepting the small loss and waiting patiently for the next high probability setup, according to your strategy. Developing a trading routine can greatly help in building discipline. Treat your trading like a business, not a hobby. This includes keeping a trading journal where you record every trade you take, including your reasons for entry, your stop loss and take profit levels, and the final outcome. Reviewing your journal regularly helps you see what is working and what is not. It allows you to learn from your mistakes and improve your strategy over time. A consistent routine helps remove emotion from your trading and encourages you to make logical, well-thought-out decisions. Finally, understand that losses are a normal part of trading. No strategy is perfect, and even the best traders in the world have losing trades. The key is to ensure that your winning trades are bigger than your losing trades over time. This is why risk management is so critical. By keeping your losses small and letting your profits run, you can be profitable even if you only win half of your trades. Embrace a mindset of continuous learning, stay patient, remain disciplined, and you will be on the right path to achieving consistent profits in the Forex market.